Hey there. For those of you who don't know me, my name is Elijah. I am a real estate professional, both in investments and development. I've been in the industry for going on 5 years now. And here are my takes on the Q4 market predictions for the real estate market in Charlotte and also North Carolina as a whole for the rest of this year. Some background about me. I am a licensed agent in North Carolina. I have my broker in charge designation, which is the highest possible level of licensure. I'm a South Carolina licensed real estate salesperson, member of the NAR. Additionally, I have a construction and development company called Forthright Homes and a property management company called Terra Trust Property Management. All this to say, this gives me a really unique insight and perspective into what the markets look like because I see it from the construction and sales side of things, from the buy side of things, and the brokerage side of things, as well as how investors view the market. And I've always committed myself to understanding things at a macroeconomic level and the greater reasons and motives behind why the market does what it does so I can maximize value for my clients and my investors alike. Now, diving into things, let's take a look here at market demand and activity for the past few months and, of course, where that's going to take us throughout the rest of the year. So days on market until sale. So this is, of course, comparing 2023, 2024, and 2025, both for August as well as for year to date. The reason year to date is important and you don't want to look at an entire year is because the real estate market is cyclical year over year. As you can see, there's these more subtle ups and downs year to year because demand tends to peak during those summer months. Point is, though, with this, days on market is increasing drastically. As you can see here, this is in tandem with when interest rates first started rising. Things were really flat in terms of 2023 to 2024, but we're seeing kind of sort of a backlog in a sense in 2025. Do keep in mind, though, that a balanced market is between 3 and 6 months. So really that 90 to 180 days on market is what is considered a balanced and normal market. So still now things are definitely turning over quicker and it's still a faster moving, more dynamic environment. Jumping here. Let's make sure, there we go. Yeah, jumping here now. Housing affordability. This is another interesting look in terms of what it actually costs to own a home. Now, keep in mind that 120 is sort of where you want to be. This is a lot of this is through census.gov, the U.S. Housing and Urban Development. 120 is right here. Okay, that means that median household income is 120% of what is necessary to qualify for the median priced home. Essentially, that means it's affordable. As you can see here, we are very much in an unaffordable time in the market. There was the recession there, Great Recession, and then housing affordability has extremely, extremely fallen because prices are currently not in alignment with rates and affordability. A lot of this comes because there's a demand snap post-COVID as we realized that the U.S. was extremely, extremely underdeveloped in terms of needed new housing units and inventory, which created this jump in prices that is still sustained and is holding strong because there truly is just a shortage out there, which causes the affordability problems. That's it. That could be another great video for another time, but just the long and short of it is housing continues to remain unaffordable. Rents are high relative to income. Of course, home ownership is high relative to income. Difference there, is if you own a home, you are gaining some principal and gaining some traction and something to call your own as the years go on. So what does current inventory look like? As I mentioned, days on market was increasing and inventory of homes for sale is increasing as well. What we've seen here is 2024, there was a 54% increase in inventory. Again, inventory tends to lag behind days on market because of the time it takes to close a home, the time it takes to list a home for sale and so on. So what you see here is, there was a decline in inventory. As when rates started going up, a lot of people sort of held their homes and said, well, I don't want to move because I don't want to lose my low rate, whatever it may be. And now we're seeing, as people are starting to need to move and desiring to move again, and realizing that rates really aren't going to come down lower, you see things coming more into alignment where inventory is increasing. Here's the historical average of homes for sale by month. Once again, you see the cyclical annual humps, for lack of a better way to put it, but inventory is on the way up from the lows during the buying frenzy of 2021, 2022. Now, month supply of homes, this is the second side of this. This is strict numerically speaking. This says how many homes are on the market. This says how many homes are on the market relative to how many buyers are pursuing those homes. Things were again flat for 2023 due to those lagging indicators getting pulled into 2023 from 2022. But 2024, there was an increase in month supply. And 2025, of course, we have seen that as well. We're up to 3.3 months. Again, somewhere between 3 and 6 months is a balanced market, depending on who you ask, which economist you ask, how things are measured, so on and so forth. But we are seeing things once again return to a more balanced market in which buyers and sellers are on equal footing. This is a greater look at the month supply of homes. What this really shows is if there were any sort of outliers, were certain homes turning over faster, or certain homes sitting longer, whatever it may be. Price range, as you can see here, month supply at the $500,000 and above threshold. And all this data, of course, is for the greater Charlotte area. For the $500,000 and above, there's been a 31% increase in inventory. But as you can see here at these lower price points, 200,000 and below, which is nearly non-existent in this market, aside from condos and some smaller, older townhomes. But this, entry level, first time buyer sort of price point at 200, really to 400, but specifically 2 to 300,000, there's very little change in the month supply, as at this affordability level, people are really grabbing whatever inventory they can find on the market. Bedroom count, you can see here, this has remained fairly consistent for 3 bedrooms and 4 bedrooms. There's been a slightly larger jump on the 4 bedrooms, and a more significant one on the 3 bedrooms as well. But the reason, or on the 2 bedrooms, but the reason you see the 3 bedrooms holding more steady than the rest is 3 bedroom, 2 bath, 3 bedroom, 2.5 bath tends to be the bulk of the market. And once again, aligns with the most affordable price points here. These are, people that have been saving for a while, possibly like yourself, that are looking to buy your first home or move into a larger home for the family. Also common, more of a relocation type product. You're going to be in this 3 bedroom territory as you are possibly, looking to settle down or get a place once you relocated to the greater Charlotte area for work due to its economic strength. By property type, single family is up 0.4 months. Townhomes are up 0.8 months. And condominiums are, of course, up the most. Reason being is condos tend to be higher on the interest rate side a lot of times from a financing perspective, and can be a little more difficult to finance. And then single family, of course, inventory is up fairly steadily, but townhomes, you do see a larger jump. One reason is a lot of developers are building townhomes, and I'll talk about the development side of things and the current inventory buildup there. Also, additionally with this, people tend to be more transient in townhomes, and townhomes are a little more commodity type products versus single family homes. The backyard, the front yard, the look of the home, all of that can very much be a big determining factor. While still important, yes, for townhomes, they are a lot more homogeneous in terms of their size, style, layout, design, so on and so forth. So you do see it being a more competitive market. Now, as for home prices, what are things looking at? Unlike a lot of markets, say Vegas, parts of Florida, South Florida, so on and so forth, where things are just essentially in a free fall, Charlotte tends to be a very robust market. We are relatively insulated in terms of our trends when we see things, the waves in which, the intensity with which we see things. So we tend to get peaks and valleys later on. We tend to peak earlier, valley later, and also see that later on in the markets, and we recover sooner. And once again, as I said, are impacted earlier on. All this to say that because Charlotte's such a move to city, it's such a growing area. Latest numbers out as of a few weeks ago were 157 people are moving to the Charlotte metro per day. It means that's a very tight market and is very much strong still in the fundamentals. So we haven't seen that bottom fall out in some of those vacation markets or more discretionary markets versus a move to employment hubs such as Charlotte. So average list price, we're going to talk about average list price, average sales price, and then median sales price, and then percentage reference points to sort of baseline that all. Average list price here. So as we can see, we were up 4.6 in 2023, 4.3 in 2024, up 6.1% in 2025. Now, average, of course, is going to be skewed from, here it is, median. Reason being is more expensive homes, if they're continuing to sell or they're being purchased cash, whatever it may be, is going to pull things ahead and be a disproportionate indicator. All this to say, though, average list price is continuing to climb throughout the past 3 years, even coming out of the 2021 sort of surge, and prices are continuing to hold steady. Big reason for this, of course, is that as Charlotte continues to mature and have more high-paying jobs in the area, it just opens up more people with greater disposable income to buy more expensive homes. And also, additionally, we're seeing some skewed things because at the very, very high ends of the market, the $1 million, $2 million, $3 million homes, those are such large sums of money moving around that they can still absolutely skew things, especially because those people are likely putting down larger cash sums due to the amount of assets they have, and or they are less sensitive to changes in affordability due to earnings. Now, average sales price, as you can see, of course, average list price has continued going up. Average sales price, on the flip side of things, though, is continuing to climb, but albeit at a much lower rate, right? Plus 5.1, plus 5.2, plus 4.7. Average sales price plus 2.8, plus 7.4, plus 2.9. This was a big jump here. Again, you figure when homes are constructed, being again, Charlotte's a newer market, so newer construction homes as they come online tend to going to be worth more than current inventory. So you're going to see that get pulled up there. And then 2025, of course, we're seeing a bit of a flattening here in terms of average sales price as home appreciation, if you want to put it that way, is falling more in line with what inflation is and what's a sustainable figure. And there's less, major, very expensive aspirational projects coming online just as builders are gauging market intensity and demand. Now, median, of course, is going to be, in a lot of ways, a more close look with the market, what you could truly expect. Being due to the fact that it's not skewed by outliers in those extremely, extremely high cost homes. So median sales price was down a bit in 2023. Again, those rate increases up a bit in 2024, and then up 1.3% for August in 2025. Year to date, though, let's look at this here. So we're down just over 0.5% in 2023. Again, response to interest rates going up and people slightly pricing that correction in. 2024 up 3.6%. So we're going to say plus 3% for the 2 years, and then plus 1.7%. So essentially, these past couple of years, things have been trading relatively flat. A lot of that is due, though, of course, is not that the market's not growing. It's just that growth is returning to a sustainable level, right? When you look here, you had a huge run up 2021 to 2022, where median sales price went from right around just under $300,000 to just over $400,000. Continuing to climb, albeit slower from there. This is not sustainable, right? This would be, if this continue, that'd be exponential growth. It'd be a sign of a bubble of sorts. This return to more fundamentals truly shows confidence and stability in the market, especially when you align it with the fact that this here was, as I talked about, the domain snap, which I definitely keep mentioning, so I should make another video on that. Now, the percent of original list price received. This, in a lot of ways, talks about and gives insight into the seller sentiment and seller mentality. Percent of original list price received here, 2023 was down 3.9%. Again, after the run up in 2021, 2022, rates start going up. So people start needing to realign themselves with reality, right? If every home in the neighborhood is going for 5%, 10%, 15% more, or 10, 15, 20, 30, $50,000 more than the prior one, people would automatically price that in. Well, when rates start going up and affordability and buying power changes, this is going to have to fall in suit, which is why we see this so abruptly, as all those homes that were priced extremely, extremely aspirationally almost snap back down to current demand levels here. Still at about 95% of list price received. Now we see here, it was down a little bit to 97.2% in 2024 and 96.1% in 2025. What this tells us here is that sellers aren't entirely aligned in terms of the market. A lot of this can come down to sort of sensationalist headlines or just honestly agents possibly promising the sun and the stars to try to win a listing, and not being honest and forthcoming and upfront with their sellers about current market expectations. There was such a big surge in price through, once again, these 2021, 2022 here, that that, again, there's just only so much ceiling, so much people can afford from a growth standpoint that needs to be brought back in line. So we see this, of course, fall off here. And what this shows is sellers are still trying to list their home and try to set a record in a sense. However, they are coming to reality and selling for those more stable, more sustained prices. Again, here coming out of the recession, let's focus on this as a good sort of meat and bones. That 93 to 97% is right around where you see things close at. Now, as for interest rates, so this is going to start getting into not just an analysis of current numbers, but storytelling in a sense for how I go about forming these opinions and predictions for what the rest of the year is going to hold. Um, this is a snapshot of Fed interest rates for the past 2022 to now, so the past 3 years. I do want to mention that this is, of course, the federal funds rate. This is, essentially the rate banks can borrow money at, the government can issue bonds at, so on and so forth. This, is ideally and mostly politically isolated. This is due to greater economic factors, but this is not, of course, what you're borrowing at, right? The banks need to make their split and so on and so forth. They have a cost of borrowing money too, they need to cover. And what you see is this is actually downstream in a lot of ways from where rates are. Banks, when they are setting rates, they're trying to predict what they're going to be borrowing money at, right? So if things, in terms of economic reports, jobs reports, um, sentiment within the Fed look more bearish, less optimistic, banks are going to increase mortgage rates because they're assuming rates are going to go up, right? You figure they issue a pre-approval or a loan and they start the process in, we'll call it uh, July, right? That's not going to close till likely August. So they need to essentially price in that 1 month worth of risk or what they see is the realistic change to stay profitable on their end. Um, all this to say is, that's why leading up to this Fed meeting in September, which I will be talking about, we saw rates go down some because banks were anticipating that rates were going to get cut, which did end up happening. So, what this really is here is showing when the last time rates were cut, which was December 18th, 2024. Um, and then again here on September 17th, so just this past week. That means pretty much 9 months went by without any rate cuts, the Fed holding strong to rates, trying to keep things at a higher level. Historical rates on mortgages tend to be about 7%. That does include, there was a peak in the 70s, 80s at upwards of 14% during that stagflation period of the U.S. economy. But typically, what I would consider a long-term, more ideal market for rates would be in that 5 to 6% range, where there's still a certain fundamental cost to money to keep things balanced, but also it keeps housing affordability and all of those economic factors and drivers that are tied to it within reason and sustained growth. Now, this is some of the headlines over the past, essentially, this would be 10 months at this point. Here, there was the cut. Fed lowers rates by 25 basis points, so 0.25% as expected, November 7th, 2024. And then, of course, there's that December 18th, the last cut. Fed cuts rates for third consecutive time in late December, heading into January. Now we look here at the start of 2025. After looking at, the way Q4 wrapped up, holiday spending, consumer sentiment, jobs growth, so on and so forth during that time of the year relative to historicals, the Fed decided to pause the rate cut cycle, which is where we see things high and holding to there. Then we see here, this sort of goes here and then up that way in terms of chronologically. This is February 11th. Powell, so, Jerome Powell, chair of the Federal Reserve, says that he's in no rush to cut rates. And then we see here, about a month later in March, rate moves may be delayed until summer. So this is starting to tell the story we see here that the Fed's in no rush to cut rates, but the Fed does anticipate there will be further rate cuts, which starts the waiting game in terms of people entering the market, buyers entering the market, wanting to essentially say, you know what, let's hold off on buying anything because we want to get a better mortgage rate if we hold out here for a few more months. And then sellers essentially saying, oh, if rates are coming down, we can continue to price higher, or let's hold out a little bit, whatever it may be, because people will likely be able to have a more affordable mortgage, because people truly don't buy homes necessarily on home price. They buy it on monthly payment unless you're paying cash, which is a percentage of the market. It's the second largest financing type after traditional mortgages, but still conventional mortgages and FHA and VA and USDA and so on and so forth do drastically outweigh cash buyers. Now here we see later on in March, Fed keeps rates steady, still sees 2 rate cuts in 2025. Okay, so the Fed is saying we're not touching rates now, but we are going to touch them by the end of this year. So once again, that's telling buyers entering the market, let's hold off, let's not do anything yet. We want to get that better rate down the road. And then we had some rougher jobs reports, higher inflation, unemployment, so on in May. So Powell came out and said, well, there's likely going to be higher rates and more inflation volatility throughout the next few months, almost indicating what's going to happen into the summer months, which tends to be peak buying season. So if you're seeing this, if you're a consumer, you're likely not seeing a blow by blow like this, but you will see the CNBC headlines or wherever it may be, the Wall Street Journal, so on. You're going to see likely, and banks are also going to be increasing rates and adjusting that accordingly based on this risk profile. So you've kicked this can further down the road now. Trump, of course, now in June starts pressuring the Fed to cut rates after a weak jobs report. Powell's chair nomination, he is up for his term's up, his third term is up next year. So essentially, if he wants to continue remaining in that position, essentially here's some outside political power trying to say, you should cut rates, essentially if you want to keep your job, for lack of a better way to put it. But we see here Powell holding strong and saying the Fed's going to keep rates steady. This is now mid-June, but he still sees 2 rate cuts by the end of the year. So he's saying we're not changing anything now. We're cutting rates later this year. And then like a week later says, once again, we are in no rush to cut rates. So he's continuing to affirm rates are coming down later this year, but we're not cutting them anytime soon. Once again, if you're a buyer and you're possibly able to extend your lease month to month or renew a lease, or you're moving from one home to another, you're going to say, well, if we wait just a little bit longer, we can get a better rate and have a lower monthly payment. And then once again, we see here now in July, US Treasury expects Fed rate cuts by September. Now they've set a timeline. People are saying, okay, it's July. We can hold out just a little bit longer and wait till September for those more favorable rates. And then once again, reaffirming a week later, the Fed still expects to cut rates this year. So they're saying, essentially, this is our timeline, and we are affirming that this is still our timeline. Here's some more information. And of course, if you want to pause and read these summaries, you can. But then we see here, this was the big news this past few weeks. August 22nd, Powell says rates, hints that rates are going to be coming. So you see mortgage rates taper off, then come down a little bit as banks are pricing that in. And then, of course, here, September 17th, the Fed cuts rates a quarter of a point at 0.25% as expected, in line with what he said leading up to that rates were going to be going in September, going back to June, July period. So what does all that mean in terms of my predictions for the rest of the year, what the market's going to look like in Q4, and as we move into the new year? Well, here we go. So this is the typical market. Of course, as you saw going way back here, I'll just show any of these graphs. All these little annual bubbles, right? Demand pops during the summer months is when there's the most buying activity. So again, this is just a very general bell curve, but this is what your demand typically looks like. Things are busiest when the weather's really nice, before the school year starts, when people are really shopping. It's a good transient time to go ahead and get yourself in a new home. And then things really taper off heading into the holiday months because, there's all the family gatherings, travel, so on and so forth. Things slow down for the year, and then things remain slow into the new year as consumer spending, and debt accumulation tends to increase in these months due to all the holiday gifts, holiday spending, travel, so on. And then we see the market really come back with more intensity during the summer months. Now, because we spent all of this peak time here with the Federal Reserve saying rates are coming down a little bit, my anticipation is that this is going to be a much more likely demand curve. And honestly, you could probably even push this a little farther in. Reason being is so many people that have been sitting on the sidelines, buyers on the sidelines, saying, I'm not going to buy a home just yet. until rates come down. Well, rates are coming down now. So that's the time as a buyer, it's great to jump in, because before the market gets flooded with a bunch of other buyers doing the same thing, you can get in now, capitalize on some great incentives, get some great deals on homes, and lock in that lower rate. So I do think there's going to be, definitely a right skew here on this demand curve for the year and what the market total volume and activity looks like. Again, these are just predictions, but based on the data that we're seeing. Now, second big prediction I have is that incentives aren't going anywhere, right? Builders are at record high inventories. They have some of the highest inventories in the past 20 years for new construction homes, and there's a ton of incentives out there. Well, as a builder, regardless of what builder you are less competitive when you have all this inventory, because there's more choice, less sense of urgency from buyers, and additionally, there is a lot more carrying costs, increased carrying costs, due to the fact that you are essentially holding and carrying all these unfinished homes or homes without deposits that are under construction, so on and so forth. So I see builders, instead of saying, okay, rates are going down, we're cutting incentives, capitalizing on this delayed demand and buyer activity, saying, okay, we're going to continue offering these great incentives. Reason being is this will give us a chance to clear out this surplus of inventory. We don't want to have this many homes sitting in our inventory. Let's clear it out. Let's bring it back down to a normal level, push these incentives through this year into early next year, get back down to a more sustainable amount of carrying cost, and then tapering incentives out from there is likely what I think we will see on that front. So what you should know? Well, if you're a buyer, you should know that rates are stabilizing. We're really entering a more traditional interest rate market where we're not going to see things at 2, 3, 4% anymore. Rates are likely going to now, depending on greater economic sways, conditions, so on, hover in that 5 to 6% range, up to maybe 6.5 as the market continues to mature. But I would not expect, that you were going to roll over tomorrow and come January, rates are 3% lower or anything. Those big swings are gone, and you're likely to see smaller little adjustments and corrections. And even a year from now, I don't see what your mortgage would cost being fundamentally or drastically different than it would, say, today if you went to buy. Also, fundamentals have returned, right? As I mentioned before, we had the demand snap in which everyone realized we just don't have enough homes in the U.S. But at the same time, that created that rapid appreciation growth. Things need to return to normal, right? Keeping pace roughly with inflation in a traditional market, and then a growing market in like Charlotte, just slightly outpacing inflation in terms of appreciation. That's more realistic, right? If you anticipate being in your home for, say, 3 to 5 years at least, great, solid time to buy, because you are still giving yourself enough wiggle room there for the market to go through its natural cycles and sessions. As a seller, what does this mean? Pricing is everything. What we're seeing now in terms of average days on market, as I mentioned, it was in the 40s and 50s. The homes that are priced right are still selling relatively quick. However, the homes that are priced way too high are sitting and sitting and sitting. So you have this weird dichotomy of sorts in the market, where there's not a ton of homes that are just sort of in the middle. There's a ton that are selling quickly and a ton that are really just sitting and such. A lot of times because, as I mentioned before, a listing agent tried to buy the listing, promised the home could sell for way more than it's worth, and then you're slashing prices and not keeping up with buyer interest at that point. Also, move-in ready condition just sells. With builders offering so many incentives on new construction homes, if you're looking at all the incentives that are offering, the fact that it's a brand new home, the homes that are priced right and are in really great move-in ready condition are what are turning over and make you most competitive in this market. That's not to say that if you have a home in need of some updating, you can't sell it. Absolutely you can. It just means that you need to be realistic. And whereas before, if a home was worth, say, 500,000 and needed 50,000 worth of updating, you could sell it for 600,000 somehow in 2021, 2022. It's saying, if the home's worth fully finished 550 and it needs 50,000 worth of updating, you're probably in that 475 to 500 range, just as the natural reality of where market's at. So that's my take on the current real estate market in the greater Charlotte area for this past year so far, heading into Q4 of 2025. If you want to learn more, please feel free to reach out. I'm always here to get connected, talk about the market, share my expertise and insight, what I see coming down the line as a builder, what I'm seeing in terms of rentals and great investment spots. value opportunities and great buys. And of course, if you're a buyer or a seller, I'm here to provide a data-driven, insight-first, honest, and integral approach to the buying process. I try to be consultative. I try to truly be forthcoming with the nature of things, and educate and inform all my clients through and through. Again, I'm Eli with Stone Realty Group. It would be so nice to connect with you soon. And feel free to leave a comment below what your thoughts are in terms of where and what we're going to see in the market in this year to come.